Hello, everyone. Today on the Final Bar, happy Fed Day. Powell and Company leave rates unchanged, leave the door open to further rate hikes later this year. Stocks sell off after Powell's press conference. The NASDAQ composite down 1.5% today. So wait in the growth area of the markets. Danielle, Shay of Simpler Trading is going to be joining us live in the studio. What's the technical take on some of those growth leadership names after the Fed meeting going into earnings season? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. Now, I'm often asked on a day like this, Fed meeting, it's all about Powell, inflation, uncertainty, the dot plot, all of these things. So where do charts fit into it? I would argue now more than ever, this is not about what the Fed has done. This is not about what the Fed might do. It's all about market expectations about what the Fed may do going forward. And those expectations, how do you measure those? Well, you can survey investors, but you can't really be sure that anyone's being truthful, or you can question the data sources and all of that, or you can look at the markets themselves, and price is a very good reflection, I have found, about investor sentiment. And when people are excited or desperate or nervous or euphoric or despondent, prices tend to move in line with those expectations because often investors will vote with their capital. They will make buy and sell decisions as motivated by those emotional drivers. So I would say talking about and looking at market trends leading into a Fed meeting, super helpful, often quiet as we sort of wait and see what happens. Dave Landry on the show yesterday was talking about when to buy, when to sell, and when to sit on your hands, arguably earlier this week, sort of a wait and see mode, see how things play out. Now that we've gotten at least some clarity, we can talk about some of the takeaways from the Fed meeting today. We will focus on the language of technical analysis, what the charts are telling us about expectations going forward. Certainly growth areas of the market selling off pretty aggressively after that press conference around 2:30 p.m. Eastern. A lot of charts to cover and ground to review in our market recap. Let's get right to it. Before we get to our recap, I do want to ask a question we recently polled all of you on. Where will Microsoft be 1 month from today? And the point of these questions is to really force you to think about different potential outcomes. What would happen if Microsoft was up 10, 20% from current levels? What about 10, 20% lower? What about somewhere in the middle? What sort of tools could you use? What levers could you pull? How could you use long and short positions, options, futures, and other contracts and ETFs to try to express that thesis through some sort of positioning? When we're looking at the chart of Microsoft, by the way, it's about a 50-50 split between the two middle points, to be honest. It was about half and half between higher or lower, generally speaking. But my main takeaway is that, 61% of the respondents, almost 6 out of 10, basically saying within 10% of current levels. And that is exactly how a chart of Microsoft certainly feels to me. When you look at the chart of MSFT today, as with a lot of the growth names sold off today, right? So down about 2.4%. And a lot of that, of course, came in the afternoon after the Powell press conference, sort of lighter volume, wait and see until then. But you saw a lot of things like Alphabet and Microsoft and others rotating lower. Now, let's be clear. These are not end-of-the-world moves. It's a down day, but again, still above clear support, still below clear resistance. So essentially range-bound, right? If you think about 10% lower, that'd be about a 32-point drop. That would take us down to 290. That would take us down to the 200-day moving average. We add 10%, that would take us kind of near all-time highs or near the July high and a retest of that level. So most of us, 60% of us, basically saying within this range. I don't think that's an unreasonable expectation, to be honest with you. I would say getting above 370 or getting below 290 seems like a kind of a long shot given the scenario that we're in right now. Now, here's the kicker, and this is going to get to my guest, my conversation with Danielle Shay here in a little while. Earnings can be a huge catalyst. And when you're looking at some of these names, it's about the supply and demand, but you have to remember a lot of those emotional drivers become magnified when you have an earnings release. That's where companies start to reflect on how they are pricing in inflation expectations, what they're seeing with consumer behavior and supply chains and all of that. So I'll save some of the discussion of the mega caps for my conversation with Danielle Shay. But thanks for answering that question on Microsoft. As a reminder, make sure you follow us on our social media accounts on Twitter and Facebook and elsewhere. You won't miss the next poll. Let's get to our market recap. As I mentioned, a bit of a distribution here. The NASDAQ composite was down 1.5% today. That takes the NASDAQ composite just below 13,470. The S&P 500 almost getting to 4,400, finishing just slightly above it, but that's almost 1% lower from Tuesday's close. The Dow was in the green for most of the day, but by the close of the equity trading session had rotated lower, down about 0.25%. So not too much of a bad day, but certainly growth underperforming value in a pretty big way. We'll see some of the FAANG sectors at the bottom of the sector return list when we get to the sector review here in a moment. Mid caps and small caps all down as well. Sort of a general rotation. Again, most of that happened in the last 2 hours, really the last hour and a half of trading. Only green you see on the front page is the VIX, which spiked up almost a full point. Now, we've talked about the volatility, so what we call a low volatility regime. We'll look at a chart of the VIX here in a minute if we can make time for it. But basically, when you're talking about volatility, I think of it in terms of volatility regimes. The VIX has been particularly low, down in the 13, 14 range. Now we've actually pushed back above 15, which is a level we've not seen in quite some time. If we do see a period of sustained elevated volatility, if you continue to see red at the top and green down here on the VIX quote every day, that's where I would start to be concerned about a much more of a risk-off move. And I always tend to describe it. People don't get kind of nervous and uncertain and then slowly accumulate shares. That's when you kind of panic sell, and that's when volatility spikes when we rotate out. Ralph Eckenpour, when he was in our studio last week, reminded me the markets go up the stairs and down the elevator. That's why volatility tends to spike when the market can rotate lower. Looking at interest rates, with all of the discussion about the rate environment, about Powell and the team, the Fed governors and what they were expecting, no big shifts in the interest rate environment. 2-year yields popped up, but at the end of the day, 10-year yields not too far off of where we were yesterday, down slightly at the long bond 10-year point and the 5-year point. 10-year yield, which is the main one we tend to focus on, still around 4.35. And again, compared to the last couple decades, pretty low. Compared to the last couple months or the last couple years, kind of high. And this shows you the difference that we've been in, right? 4.35 seems outrageous if you remember the 10-year yield at 0.7 or 0.8%. Now we're quite a bit higher than that, but historical averages are well above current levels. So good reminder of the historical context. Bond prices pushing up a little bit. The dollar index overall has been trending higher, but it really didn't finish the day much higher than yesterday's close. The UUP was up slightly from Tuesday's session. Commodities overall, some red that you see on the chart here. Gold and silver up slightly. Gold was just above the zero level. Chart of gold is an interesting one, and we talked. I think it was on it was on our live Q&A earlier today. Actually, don't miss that next one. By the way, every Wednesday, 1 p.m. Eastern, we're having a good Q&A on our YouTube channel, just going through whatever questions come through the chat. We were asked about gold, and so talked about the chart of the GLD, a potential rotation higher. We'll try to get to that chart here in a minute if we could. A lot of red here on some of the energy-related ETFs, particularly oil and natural gas. Finally, cryptocurrencies mostly in the red today. You can see Bitcoin down about 0.9%. Ether prices down 1.6%, nearing that crucial 1,600 level. Bitcoin actually back below 27,000. Now, Bitcoin has bounced off of 25K, so still up from that level of support, but showing some weakness here through the course of this week. Sort of a risk-off move along with other risk assets. Finally, I'm never super jazzed on the offensive side of the market when I see defense at the top of the list. So the top 4 sectors are real estate, consumer staples, utilities, and healthcare. That is the defense on the field, folks. That is not the offense on the field. That would be some of the growthy FAANG sectors at the top of the list, or even some cyclical sectors. These are more pure defensive sectors like real estate, staples, utilities. Now, none of these were up big, so let's be clear. Pretty much most things were flat to down, but the underperforming sectors are where a lot of the market cap is in the S&P and the NASDAQ, and that's why the NASDAQ is down so much. Technology down 1.6%, really driven by some of those mega cap names giving back some of their recent gains. Communication services sector with Alphabet and others down 1.4%. Materials and consumer discretionary essentially tied for third from the bottom, down about 1% for the day. Let's go to a daily chart of the S&P 500, see what sort of conclusions we can draw. I was interviewed earlier this week and was asked about just the chart of the S&P, main thing to look at. And what I reminded the reporter was, what I like to do is just literally take a step back or two from your screen, literally get up out of your chair, wherever you're at, back up a little bit, and just what are your general takeaways? For me, this immediately looks like a distributive pattern, a toppy. We would always say the chart looks toppy. Now, I don't like to drive investment decisions based on general impulse reactions to the visual cues on the chart, but it does sort of give you an idea of what jumps out, right? What jumps off the page at you. And this looks like a potential head and shoulders topping pattern with a head surrounded by a right shoulder and a left shoulder, or to rephrase, a high surrounded by two lower highs. You have a clear neckline with the June low and the August low. You wait for a break of the neckline to complete the pattern. So I would hesitate, and I would encourage you to caution any sort of view that would say this is a top, and here's why. The head and shoulders pattern, if you look at Edwards and McGee and John Murphy and Martin Pring and others that sort of wrote, Charlie Kirkpatrick and Julie Dahlquist, the ones that wrote sort of the main literature on technical analysis that we still use to teach it today, they talk about how a pattern like this really is only valid when you break the neckline. Some of them, like Edwards and McGee, actually talk about the volume characteristics and how there needs to be a certain volume, a lightening of volume, and then an impulse move, a breakdown on heavier volume. And if you don't see that, it's really not a true head and shoulders topping pattern. I would encourage you to go to our chart school page if you want to learn more about patterns like this and what levels you're looking for. But I would just say the S&P goes below 4350. That would complete this topping pattern and suggest much further downside to around 4050 to 4100, depending on how you would measure that pattern. Just using that particular form of pattern analysis. We don't break below 4350 though, and this is still a market just in a consolidation pattern, right? Just sort of holding ground and holding support. So the levels that complete the pattern are often very important. The S&P, by my read, not breaking that down just yet. Now, certainly other things have been breaking down, which we'll try to get to if time permits. Now, just briefly, I wanted to talk about volatility because we saw the VIX spike up almost a full point today. When you're looking at things like the VIX, and here's my chart of the VIX going back the last 2+ years or so, and if you look at this, again, this is the range in the VIX in the last couple months. We've been sort of in that 13, 14 level. Now, a couple times we've had these spikes. Most recently in July, we popped up. The VIX topped out around 17 and change. This was when the market pulled back right around here after the June peak. Then after the August peak, you saw the market pull back for about 2 weeks or so, of course, coming off of the 4,600 level. The VIX spiked from around 13 to around 19. So are we seeing a similar pattern? Well, it starts with a day like this or a week like this where you start to see an increase in volatility. Now, that's not a guarantee that prices are going to go down a certain amount of time or to a certain particular price point. I think that's more how you would use the analysis of the chart itself. That's why you'd analyze the chart of the S&P to develop some sort of downside objectives. But it does tell me this is something to be wary of because the more that volatility spikes higher, that's not something you tend to ever see in a bullish phase. That usually means that investors are going risk off, investors are getting nervous. This is why it's called the fear gauge, because people don't get fearful and then buy stocks and sort of sit back and see what happens. You get fearful and you sort of unwind positions. That causes often a negative feedback loop where things continue to go lower. So S&P testing 4,400, VIX pushing right to 15. I'd be interested to see if we finish the week above current levels, maybe above 16. That would be sort of a risk-off way of finishing this particular week and would play pretty well with the normal seasonal tendencies, which would often expect a weakness September into October. I mentioned the chart of gold, and again, in our live Q&A earlier today, we had a question about the GLD, and we spent a couple minutes just looking at that chart. I'll share with you some of the key takeaways. When I'm looking at the chart of gold, again, take a step back. What jumps off at you? For me, it's the fact that gold obviously has been going down over the last 4 or 5 months, but tested key support, and this is around the level of 175 to 176 for the GLD. And again, spot gold, very, very similar to the chart. We're showing just different levels, a little bit different price behavior, but very, very similar. They're very closely related, of course. So if you look, the GLD pulled back to a June low around 175, we'll call it 176, bounced off of that, came back down to retest that level in mid-August. This is as the S&P was sort of testing resistance and then rolling over. You can see gold pushes higher. Now look at the trend line from the high in May, the peaks in July, subsequent peaks in August into early September. And now just this week, we are breaking back above that level. Now today, you have a bit of a distributive candle pattern. It's what you might call like a shooting star candle, where it's open and closed near the lows of the day and a big upper shadow that may suggest the next day or two is overall a little bit lower. But what I'm seeing is a higher low. I'm seeing us now break above trendline resistance. I'm seeing the momentum, and this is something to watch. Actually, while we were doing the the Q&A earlier, gold was actually up at the top of the range, so the RSI was pushing above 60. Now it's actually come back down below there. Good reminder to wait until the close to see how the day plays out, particularly on a day like today where we have a catalyst in the afternoon. But I would be looking to see if the GLD can get above that swing high at the end of August. That means GLD above 181 on improved momentum. This all of a sudden, I would argue, completes a rotation to more of a bullish phase. Most recently, the higher low is not something to ignore. A couple other charts to finish off here as we finish our market recap here with a minute or two. You know, I'm looking at technology share. I'm looking all over to see how things were playing out going into the Fed meeting and then coming out. Obviously, a lot of movement in the last hour and a half of trading. Western Dig, overall trading higher, ended up being kind of an interesting day. I'm going to zoom in a little bit. I have this chart where we focus a little bit on the short-term dynamics. Now, again, this is what a number of stocks did. Western Dig was actually up here almost to 47, which was a push above the swing high right around Labor Day. And that, to me, seemed like a very compelling development. The stock had gapped higher, and then you saw buyers continue to push higher. By the close, though, WDC back at the lows of the day, and this forms what's called a shooting star candle. What a shooting star candle is number one, you're in an uptrend. Then you have this particular one bar or one candle pattern where the open and close, the body of the candle is at the lower end of the range. You have limited lower shadow and a long upper shadow. So think about what would happen during the day to create this particular chart. You would open at the lows, you would trade higher, you would close back at the lows, sort of an inverted V shape. Is how the intraday dynamics played out. Overall, that often suggests weakness going into the close. That usually indicates that initial buying out of the open was what met with plenty of sellers, or there was an exhaustion of buyers. It's rotating more to a position of weakness. A chart like this suggests short-term downside over the next 1 to 3 bars. We'll finish off with one final chart, Amgen. Now, this is one that actually did finish more toward the highs of the day. Friendly reminder, regardless of what the macro environment is, it is always a good time to use our scanning engine, use our alerts tool to focus on names that are actually moving. A chart like Amgen actually making a new 3-month high on today's close, up almost 3% today. So it's a time when stocks went risk off into the close. There were areas like in biotech and others actually showing some strength going into the close. That's our market recap for today. Again, a lot to unpack around the Fed meeting. We'll continue to follow some of these charts in the next couple days. We're going to take a quick break and we'll be back with my guest, Danielle Shay of Simpler Trading. We'll see you in a minute.
Investing is hard, we make it easy. StockCharts' technical scan workbench provides members with the tools to instantly find opportunities in the stock market. Run your scans on over 50,000 symbols in our database to help streamline your investing workflow. Using custom scans enables you to find new trades and investments in seconds. Predefined scans let you access our extensive collection of pre-built bullish and bearish technical scans. See what's moving the markets and find essential charts to watch by following our predefined technical alerts. Predefined scans make life easy to filter the market for promising opportunities. Scheduled scans let you set any of your technical scans to run automatically at a specific time. You can choose to save the results in a brand new chart list or into an existing list from your account. When your scheduled scans run, you'll automatically receive an email with a link to the day's results. StockCharts, built to empower the modern investor.
Hey everyone, welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. We have a great guest today. Danielle Shay of Simpler Trading is actually right next to me here in our studio in Redmond. Should be a lot of fun. Before we get to Danielle's thoughts on the markets here, a couple quick announcements. First off, we welcome your feedback on our show, but we especially are hungry for your questions. Our mailbag can always use another question or two. What are you running into as you were trying to use technical analysis, trying to analyze the charts, trying to make sense of these markets using stocks, ETFs, and other asset classes? Our email is thefinalbar@stockcharts.com. We're on X @FinalBarSCTV. Just tag us in a comment there. On our YouTube channel, of course, go ahead and like this video and subscribe to our channel while you're here, but certainly drop a comment below with any questions that you have about technical analysis. We'll hope to answer one of your questions in our next mailbag segment on Friday's show. As a reminder, we had a great live Q&A earlier today, 1 p.m. Eastern every Wednesday. We set up in our podcast room. We start to take some questions. We went all over today, talking about prep for the Fed, talking about precious metals, non-U.S. stocks. We looked at an Indian biotech name or a clean energy name, if I remember right. A lot of different places. We'll go anywhere you like. Join us for the next one. If you look on our YouTube channel under the live column, you can see the upcoming live Q&A next Wednesday, 1 p.m. Eastern. I want to welcome on today's guest, Danielle Shay. Danielle is the VP of Options for Simpler Trading. Normally, Danielle, we're talking to you from Austin, Texas. Today, we're talking to you right here, which is a pleasure. How are you?
I'm great. How are you? It's amazing being here.
It's good to have you back, and it's been fun having you in the studio here a couple times now. You know, today, obviously, an uncertain day, a lot of question marks, sort of this sitting on your hands week up until today. Now, all of a sudden, we get maybe some insights about what's headed next, but I think a lot of eyes on growth leadership. Some of the top performers year to date now starting to pull back a little bit. When you look at the environment for growth stocks here, what's your overall take at this point?
So when you look at it here, this could either be the best buying opportunity or this is going to be a rough winter. So right now we have a bunch of stocks that are sitting on their critical support zones, right? And we also have a time frame where we're going to be entering the pre-earnings momentum time frame, okay? So we have earnings season that's coming up in October. And you know, I will tell viewers that Q3 can always be the most dicey out of earnings for whatever reason. But I have a couple different stocks that I'm looking at that do historically have that pre-earnings rally. Now, I'm going to be looking at these and I'm going to be trading them, but I am going to have a tight leash because if they break support and they start falling, these stocks are also going to be the first ones that tell us that this is going to be a rough winter.
Yeah, and the problem is with some of these mega cap names we're going to talk about, if there's weakness there, I feel like the benchmarks have no hope of doing anything but going down, right? They're just such a big weight.
Exactly.
We have three of them set up. Let's talk through each of them one by one if we could. When you're looking at Amazon, sort of a, you know, obviously undeniably a strong trend, but when you're looking at it this week, what stands out?
So when you're looking at it this week, the number one thing that's going to stand out to me is that once we get into trade next week, we're going to be within a 21 bar time frame prior to earnings. And the reason why I like this stock is because so far you can see that it's holding up above the moving averages. We have really neatly stacked moving averages, and we have a beautiful gap that occurred after earnings last quarter. So typically when you see a really positive reaction like that after earnings, that momentum can go into earnings the next quarter, right? Because you have investors that say, hey, I want to buy into this stock because it may gap up again. And so I'm watching Amazon. I would like to see it hold up above 130, 135 to continue trading this one to the upside. Admittedly, it's sitting right on that zone right now, right? So if it breaks down and we see a trend reversal and Amazon starts to pull consumer discretionary lower, that'll be a red flag. But as of right now, you know, this is a setup that I use every quarter. And it's definitely one that I'm going to be focusing on right now.
Amazon strikes me as one of those charts that it seems like one of those basic buy on the dip sort of patterns. And you've seen how many times we've had these pullbacks. But I feel like, you know, if it ends up being a significant top, it initially feels like a buy on the dips, and then all of a sudden it doesn't, right?
Exactly.
So how do you differentiate between the buyable dips and get out of the way, things are getting worse? Is there a particular level? Is it the combination of moving averages you're showing? Like, what would tell you to start to get less optimistic about a chart like this?
So, you know, typically what I do is I stick with the trends and I stick with the patterns, knowing that there's always going to be that one dip that keeps dipping, right? And so when you're looking at this, I love the stacked moving averages. I love the price of the moving averages. Typically, the 50 simple is going to be my line in the sand. That's going to be that yellow line on the charts right there. I really like to see stocks holding those zones. I also use a lot of Fibonacci analysis, and I use symmetry. So I'm looking at the chart, and you know, without the levels on there, just eyeballing it, you can see that the pullbacks on that chart are very symmetrical. So The time where I would say, okay, you know, this isn't a normal pullback, this is breaking, is when you'd see those candles break below the support zones. You would see a dip that's bigger than the previous pullbacks. That's a huge sign. And then whenever the candles fall below the moving averages and they try to come back above and those moving averages then create resistance, that's really where you see the trend shift, where I say, okay, you know what, buying the dip this time did not work. I need to cut it and watch out below.
It's so funny. I feel like a lot of traders, they keep trying to find the holy grail that never gives a bad signal. And I always tell people, if you get stopped out, that's not a bad thing. That actually
Exactly.
could be a very good thing. That just means it's working and you have a money management process. When you mentioned stacked moving averages, are you looking at this combination? So there's like the 50-day, I think 100-day, and the 200-day. Is that what you're referring to, or is it something else that you're looking at on the chart?
Yes.
It just tells you it's overall in good shape.
Yes, definitely. Yeah. So I have the shorter moving averages, or at least
Yeah.
the quicker moving averages, the 8, the 21, and the 34. So typically I like to see those in a nice, cleanly stacked fashion. And then certainly the 100, the 50, and the 200 simples as well. In a perfect buy the dip scenario where, you just close your eyes and buy it every time it pulls back, all of the moving averages will be stacked. But I mean, with the way that the market's been over the course of the last year and a half, we don't have a lot of those perfect scenarios. Amazon's pretty close, but
let's take what we can get here
into
into 2023. All right. Let's go to two. You have two others. One again in the mega cap space. Alphabet's another one. Just a nice consistent uptrend. Is it a similar take here, or anything unique that you'd want to point out?
So it's a very similar take, and I mean you'll notice that with my setups, and that's because I'm looking for patterns, right? And so with this one, it has the same thing. You have those stacked moving averages. You have the candles neatly above those zones. Right now, even though Alphabet was down today, pretty big down day, you're still up above the 34 EMA. So I like to see stocks above the 34, above the 50 for good buy points. And then what I really love about this one that was similar to Amazon is that you have this gap up last quarter after earnings.
Right.
So you have that, you have a positive earnings reaction. This one also statistically, like Amazon, they'll move about 3 to 4% during that 21 bar time frame going into earnings. And so, I think that with the pullback right here, it's actually not that bad because it was so strong. And so if we can get a nice pullback into 130 or so, then that could make for a great buy going into October.
It's so funny. So many of these names have had such a run. So while it feels rough to have like a 3% down day, there's so much room below these levels that I think still could be a totally constructive chart. That's really interesting. Meta, obviously another one, but a little different in configuration. This one actually pulled back a little bit more in August. What's the take here?
So I really like this one because, again, I feel like I'm repeating myself, but it had these gaps up post earnings, right? Your moving averages are not stacked on this chart, but here's what I'm going to point out is that that's because this one's in a squeeze. So if you look at the histogram down on the bottom, you're going to have some red dots and some series of green dots. Those red dots mean that you're in a squeeze and that chart is consolidating. So this one actually looks a little bit better than the other two because I love when there's a TTM squeeze directly before an earnings report. So typically when you have that TTM squeeze, you're going to have the chart pulling back, you're gonna have that tight consolidation, and you might not have the nice trend, but that's because you have a pullback. And so that's why I actually like this one going into earnings.
I feel like every time you've come on, we've talked about the squeeze indicator. I now use it on my charts, and it's mainly because of how you've mentioned it. And from my understanding, it uses Bollinger Bands like Keltner channel. It's looking at what John Bollinger always talked about, which was low volatility and looking for an expansion. So if this is in that sort of scenario, low volatility, kind of a consolidation, what would you look for that would tell you, okay, this is now the trigger? Like what, is it a break out of that resistance to the upside, or what would tell you it's a go time for Meta?
Oh, definitely. So typically with the squeeze, I actually like to get in before it starts breaking out.
Right.
So I think right now with it sitting on support at the 34 and at the 50 simple would be a great time. The breakout zone would really just be above the most recent high. So it looks like maybe 310 or so. Right up above there, right up above that most recent high. You would also want to see the squeeze histogram continuing to move to the upside. You would want to see light blue on that histogram, which would just be positive upwards momentum. And then also that red dot on the squeeze histogram, that would shift to green. And so that would be the squeeze firing. And, I would like to see Meta trade up into about 320. So I think you have some pretty decent upside there. And, if it could get above that resistance zone, then Onwards and upwards.
We'll take it.
Yeah.
When you're looking at some of these names, when you think about stocks and trends like Amazon, like Alphabet, they've just been so fairly consistent. Do you have anything in your toolkit that you use to project where to anticipate when you're going to new highs, or is it just for you a trend following exercise? I'm going to ride this until it stops, or do you have some objective you're looking for, and how do you define that?
Oh, definitely. So I use a lot of Fibonacci analysis,
Sure.
And then I also am an options trader. So I use high open interest where you have a lot of activity in certain call strikes. So when you're looking at Amazon on this daily chart, just eyeballing it, it'd really be up around 150.
Yeah.
So I typically look at Fibonacci extension targets on the daily and then on the weekly chart, and I like to overlap those. I overlap those with high open interest values in the options market, and then also if there's any previous resistance zones. So it looks like Amazon is around 140, 145 or so. So typically I target the resistance first, and then I target the full Fibonacci extension target.
Right. Well, as we continue to build out our options platform on stock charts, I hope we can dig into some of those examples in particular. It's really interesting how you combine the technical, the volatility, the options data all together. Great to see you, Danielle. Welcome back, and we'll hope to have you on again soon.
Thank you.
It's Danielle Shay. Danielle's the VP of Options at Simpler Trading. Great to have her live in the studio here. And again, I love talking about some of these mega cap names, some of these buyable pullbacks. When we had Ralph Ekampor in the office last week, it was just so refreshing, just the simplicity of looking at higher highs and higher lows. Some really good examples of names that have potentially pulled back and how to define that risk. Because if you start to break down below levels, that's where things can get ugly very quickly. I think Danielle very appropriately described the potential for return and also why to focus on the risk as well. We need to wrap the show, folks, and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. When we're talking about the markets pulling back, I'm always looking at some macro techniques just to get a sense of what levels may be important and what can help me define a change in trend. I would argue the long-term trend's obviously still quite healthy for a lot of the major benchmarks. As I mentioned with my guest Danielle Shay, a lot of them have so much room to pull back because they've had such a run so much in 2023, particularly in June into July, into August for many of them. When I'm looking at an equal-weighted S&P 500, which is the top panel, and equal-weighted NASDAQ 100, which is the bottom panel, I can't help but notice that the equal-weighted NASDAQ is actually breaking down through trendline support today. This is actually this week, and the cap-weighted NASDAQ also breaking down through that support level as well. The S&P is much higher, the equal-weighted S&P much lower and closer to that support because some of those mega cap names have held up pretty well. I'm watching these equal-weighted indexes. If they break down, which they seem to be starting to do, that tells me to just think about downside potential, to focus on names that are breaking down and make sure that I preserve capital for when some bottom occurs, because if we do break down, the one thing I will guarantee you is there will be a bottom at some point, and it'll be our main goal to try to identify that. Chart number 2, when I look at the NASDAQ 100 in a little more detail, we're doing our live Q&A earlier today. Had some questions about the NASDAQ and just looking for more color on what was happening there. I think if you're trying to get a read on the NASDAQ 100, looking at some of those leadership names like we reviewed today, Alphabet, Meta, Amazon, those will help you get a sense of what the Qs are doing. What jumps off the page at me is a lower high. And I was taught Charles Dow Theory 101, higher highs and higher lows is an uptrend. The opposite is a downtrend. I get concerned when I see a clear lower high. I get more concerned when I see a lower low. That may be happening, but it's not there yet, right? We're still sort of in a pullback mode. The momentum, though, is a little more bearish than I would like if I'm optimistic here. I'm seeing an RSI top out just below 60. And that usually is more characteristic of a bearish phase than a bullish phase. But with all that in mind, price is king. So let's focus on key levels of support. On the QQQ, 360, 355, that's the level that we bottomed out in August. Do we hold that on any further pullback through the remainder of this week into next and maybe into October? Finally, look at some key groups. When I'm thinking about groups that have had a good run for much of 2023 and starting to pull back, but with plenty of room below current levels, semiconductors probably it. Even names like Intel rolling over, but if you look at some of the semiconductor leadership names like NVIDIA and others, they're having a bit of a rough time here recently. The SMH was down 1.6%, but look at how much further we can get to just to get to the first level of Fibonacci support, which happens to line up with the 200-day moving average. I'm always keen to find what I call a confluence of support, different techniques, different approaches all coming up with a particular level. That's right around 131 on the chart of the SMH. This tells me if we do break down a little bit further, I see that as a topping pattern, and there's your downside objective built in using some of these different technical disciplines. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close. A special thank you to Danielle Shay of Simpler Trading joining us live here in our studio. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.